Welcome to Smarter Markets, a free weekly podcast featuring stories from the entrepreneurs and icons of commodities, capital markets, and technology, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we explore the questions: is capitalism in crisis? And will building smarter markets be the antidote? And now, here's your host, Eric Townsend.
Welcome to the 8th episode of Smarter Markets, a weekly podcast that explores how financial markets could be redesigned and improved to better serve market participants and society as a whole. Smarter Markets is made possible by a grant from Abex Technologies. I'm your host, Eric Townsend. Some of you have asked us to broaden the Smarter Markets discussion from commodity markets to stock markets. So my guest this week will be Jos Schmitt, founder of the NEO Stock Exchange in Canada. We'll discuss what Jos sees as wrong with the way existing stock exchanges work and why Jos saw the need to create a new exchange that's designed to level the playing field and eliminate the unfair advantages that other exchanges give high-frequency traders over other investors. My interview with NEO Stock Exchange founder Jos Schmitt is coming up next.
And now, with this week's special guest, here's your host, Eric Townsend.
Jos, I am a huge fan of privatization in almost any business. I think that when government bureaucracies are in charge of how things work, it never goes as well as when free enterprise determines how businesses best serve their customers through competition. It's just, that model of capitalism has proven itself for centuries, and I really believe in it. But, in your business of stock exchanges, it feels to me that something went wrong with the privatization, because we have seen about 20 years ago the privatization of stock exchanges, but it almost feels like the customers that the stock exchanges are serving are not the customers that the stock exchanges exist for the purpose of serving. How is that possible? What happened here?
Well, Eric, I totally agree with you. I agree both with your belief in what is the right model, free enterprise, but I also agree with your view that with stock exchanges things went wrong. And the reality over there is that stock exchanges, we have to remember that they are there to bring together in the most efficient way investors seeking to achieve financial security, wealth, with companies seeking to raise capital to enable their growth and contribute to the economy, contribute to employment. And when stock exchanges became private or public companies, in fact, but no longer being driven by the dealers, the membership model, if you want, which was the old model of stock exchanges in the past, their entire view of life became, how do I maximize shareholder value? And the way that they started to do that, and the way they're still doing that today, is by developing their services and putting their focus on services that are all about maximizing profitability to the benefit of the shareholders. And that is not necessarily to the benefit of the investors and the capital raisers. Let me give you one obvious example. The entire focus that exchanges have nowadays on the high-frequency trading community. Like, I'm not against high-frequency trading firms, to be very clear with you. I think they can add tremendous value. But I also believe that if you let them operate unleashed, that they can be detrimental to the quality of execution of long-term investors. I think they can be detrimental to the liquidity of certain corporations because they impact the ability of genuine market makers to support those securities. And what have exchanges done? They have enabled that community. They made it easier for them. They welcomed them without any restrictions. And why? Because they generate a lot of volume, because they are willing to pay extra fees to get faster connectivity. They are willing to pay extra fees to get a specific type of market data service that is better than what everyone else has. And exchanges supply that, and exchanges help with that, because they just think, well, the more volume that they do, the more revenue I make and the more I contribute, to the profitability of the organization, and that's to the benefit of the shareholders. But who's the loser here? The investor and the capital raising firm. And that is the big issue that the privatization of stock exchanges, or the fact of stock exchanges becoming public companies, with a duty to shareholders, has led to. Stock exchanges forgot about the prime objective of being there to bring together investors and capital raisers and to service them. And now they are servicing parties that can add value, but they are not managing them to the interest of their core customers, which is really part of a public interest role that stock exchanges have.
Now, this led you to create a new stock exchange in Canada called NEO. I'm assuming that the discussion we just had plays into that. So what are the reasons that, Canada already had stock exchanges. Why did they need a new one? And what are the values and principles that are behind this particular venture?
These principles are indeed, or this development, I should say, that stock exchanges went through is definitely one of the core drivers behind the creation and the launch of our exchange, the NEO exchange, the NEO Stock Exchange. And what we saw is that evolution that we talked about earlier with stock exchanges, which translated itself in the way that they operate trading, but also translates itself in many other ways. Think about the cost of market data, a big debate everywhere in the world, in the US, in Canada, in Europe, that the dealer community, investors are complaining about how expensive market data is. Are exchanges doing anything about it? No, because they say again, the more I can charge, the more money goes to my shareholders. But it's a big burden on the dealer community. It's a big burden on the investor community. The listing business, exchanges, and Canada is worse than many other places in the world. Exchanges look at listings as transactions. The more transactions I can do, the more revenue I generate. Is it good for the company to go public? Not always. Is it good for the investors that certain companies are public? Not necessarily, but they still do it. And once they are public, they forget about them. They don't support them. They don't help them. Those kinds of things, we saw developing, as I said, globally, even to a larger extent in Canada. And in Canada, amplified by something else, the fact that we only had one single main board or senior exchange, the TSX. Like at least in the US, you have NASDAQ and NYSE that compete with each other, and that helps to compensate a bit for that because people are going to try to make a difference. But we didn't even have that in Canada, so it became obvious that we needed to come with a new exchange that was going to address those issues. And when we then set up that exchange and we created it, we said something that sounds a little bit like motherhood and apple pie, but is in fact very true and very genuine in what we are and what we do. We wanted to set up a stock exchange where investors and capital raisers come first. Everything that we do, everything that we put in place, every functionality or service that we develop, we test it and we think about how is this going to benefit the investor? How is this going to benefit the capital raiser? And we made a bit of a bet at the beginning, and it sounds, again, a bit funny when I say it, but we made a bet at the beginning when we launched this. Can we be commercially successful as a stock exchange if we do what is right? Because there's not many stock exchanges doing that. And you know what? We've been operating for 5.5 years now, and I can tell you that the answer to that question is yes, because there is a clear need for a different type of stock exchange that is going to come back to that core purpose of bringing together investors and capital raisers in the most efficient possible way.
Jos, first of all, on a personal level, I'm just listening to you. I'm cheering. I'm jumping up and down. I'm applauding because I just think this is so badly needed. And it's not just in stock exchanges. It's the entire financial industry, in my opinion, needs to take a big step back and remember what is the purpose for which these markets are allowed to exist in society in the first place? And the answer is it's to facilitate the efficient formation of capital in order to support the growth and expansion of businesses, which creates more employment and more prosperity for entire nations, so that people have a higher standard of living thanks to the existence of financial markets. And there's nothing wrong with guys like you and me making a few bucks, whether it's trading or running an exchange or whatever, but it should be in service of those objectives that benefit society. So I personally am your biggest fan, but now I want to play devil's advocate and say, wait a minute, why wouldn't, if I was a shareholder in your company, why wouldn't I, really confront you at the next board meeting and say, Jos, what's this Boy Scout act that you're giving me about doing the right thing here? Look at what our competitors are doing. They're basically, if you're taking an analogy to an auction house, you can run an honest auction house, or you can get the most active bidders, the ones that do most of the buying, and you can take them aside and say, look, we'll give you guys special rules that most people don't understand, where you get to step in front of everybody else in line. You get the last chance to have the bid. The auctioneer is going to give you favorable treatment that the other guys that are the equivalent to the retail investor, they don't even know what's going on. And we're going to charge you exorbitant fees to do that. And you're going to get rich because you're cheating those people, and we're going to get rich because you're paying us a cut. Everybody's doing it, Jos, and you're not, and the other exchanges are making more money than we are. And what's to stop a private equity company coming in, an activist, and doing a hostile takeover and firing you because you're stuck on this doing the right thing when you could make more money by participating in what I think is a scam? But it's a scam that seems to be legal, and it's been going on a long time.
It's an interesting way to put it, Eric, and I'm going to try to answer that in a multitude of ways. And I'm a big believer in values and principles, and that is probably the first comment that I would make. And what life has taught me in the many years now that I've been active in this space, and funnily enough, in the exchange space, whether it's in Europe, in the US, in Canada, or other parts of the world, even, that is that the short-term approach, like maximizing profit, taking advantage of people, is something that works on the short term. It will always get back at you at one moment in time, because people realize there is an issue. People are frustrated. And the ones that will come with alternative solutions that are going to be driven by the better interest of what we are all about as stock exchanges, as you said earlier, will win and will emerge. That is what I fundamentally believe. And if there is no competition and you can do whatever you want, well, you will do whatever you want until there is competition. And that is what happened here in Canada. So we created competition with a different set of values. And that differentiation now is what allows us, in fact, to be successful and to achieve something which no one believed when we came with the concept of NEO. Like, everyone was telling me, like you said earlier, why another exchange in Canada? The country is already 1/10 of the size of the US. You really need more exchanges in a country like that. And guess what? Yes, we needed one, but not only we needed one, but we are also commercially successful because we executed upon that bet that I mentioned earlier. And we are generating profitability, and we are growing, and our revenue is going up. And month after month, we seeing more success, and we see more listings coming to us. And our market share in the last month went up again with 1 to 2%. And more people get it and see what we are doing differently, understand the value that we bring to them as investors, the value that we bring to them as capital raisers, and say, hey, you know what? This exchange is really doing things in a different way. We want to work with them. And what are we doing that way? We are, in fact, taking market share away that no one ever expected from the incumbent. And we are not only doing that, in fact, we are also growing the pie, because people that had a bad taste about the exchanges and the way that they operate, who had bad experiences, moved away from stock exchanges. And we see some parties like that coming back and being interested again. And I think that you not only develop the success, or we don't only experience success because of the competition and taking market share from our competitors. We also experience it because we're growing the pie, and we're adding value to the society, as you said, or to the community here in Canada and now beyond, with what we do. And if I look at the shareholders and I talk with them, what is interesting to know that is, one, our shareholders are a group of quite meaningful financial institutions here in Canada. Both institutional investors and dealers, with the majority of the ownership, by the way, with the institutionals. And they stood behind NEO and that vision that we had because they wanted to see change. They wanted to see an exchange that would do again what is right for the investor and right for the capital raiser. And they were ready to support that. They were ready to take that bet with me. And now they're looking and they're saying, hey, you know what? Not only have you delivered on that vision, are you providing the kind of services that you promised, but you're also making good money. That is interesting. And you are establishing yourself now as a meaningful, sustainable competitor in this space. And what makes you unique and differentiates you is those values. So that feels really good. I'm happy as a shareholder because I see the strategic intent being executed upon, but I also see returns coming. And those returns are there because we are different, because we are a competitor, and because we do other things also, like driven by those values, we innovate continuously with new ideas. And the other thing that we're doing, that is that we have an impact on the incumbent. Like step by step, the incumbent is adjusting. Step by step, they are coming with new features, new services, which are similar to ours. And what we are creating, in fact, is a better ecosystem for everyone, where not only we are doing things respecting those values, but where our competitor, not necessarily willingly, but where our competitor is starting to show a much better behavior also. So I think it's a win-win for everyone, including our shareholders. And I do not expect them in the short or long-term future to come to me and say, hey, Jos, if you would do this things, you could generate a bit more revenue. Because my answer would be, and they know that, and that is how they think also, that is, that short-term thinking is maybe going to generate some additional revenue for us in the next 3 months, but it's not going to make us be who we are. And it is who we are that has driven our success. And if I take a step back and I look at the first years, setting up an exchange, I've been through it a few times now in my life, is always difficult. How do you get your first trade done? How do you get your first buyers and sellers coming together? How do you get your first listing done? How do you get this? How do you get that? How do you get your data on all the screens so that everyone can see data? Because if there's no data available, no one wants to trade on your exchange and no one wants to list on your exchange. And we were several times put in a position where people came to us and said, Jos, if you change this, we're going to start providing liquidity on your exchange. And I said, no, that is not who we are. And we had issuers that came to us who said, if you would change that in your requirements, we would be happy to list with you. And I said, no, this is not who we are. This is not what we stand for. And, we fought our battles and we did a lot of education and a lot of explanation. And then ultimately, you start to see the early adopters. You start to see people having a good and a great experience. And you need some, lighthouse events on an exchange. And then, the beauty of an exchange is then and all those businesses, then the ball starts rolling. And the ball starts rolling because, you have to be a little bit smart probably with your shareholders also. You have a couple of shareholders that are going to stand behind you and support you not only in words, but also in acts. And then the ball starts rolling, and then people see that we walk our talk, that we execute upon what we say, that we have better quality of execution. Then they see that when you list with us, what I say about our focus on liquidity, our focus on helping with investor outreach, our partnership approach to issues, they see that it's real, that it works. One of our issuers today called MindMed. So we were the first exchange to list a company in the psychedelics-inspired biotech space. That company now on Neo became a unicorn. They start with a valuation of about $100 million, 80, $100 million. They are now north of $1 million US. And a similar company in that space that listed directly on NASDAQ in the month of November traded substantially less in volume and traded less in value than the one on Neo. Why? Because all those components we spend so much time working on, thinking about, listening, because you need to listen also to your investors and your capital raisers, understand their issues. By working on all of that, we build, a value proposition which I think really works. And then when you see success, more people come to you, and then it accelerates, and it accelerates. That's a bit where we are now. We are now in a phase of acceleration, of accelerated growth. And I got to say, good old principle worked again. Do what is right, and think about the long term. Think about the value that you bring, and people will come to you.
Jos, I want to move on to the core topic of this podcast, which is how financial markets can be made smarter, either through their functional design or through the adoption of technology. Now, my own personal background, my expertise and knowledge is in commodity futures trading. So when I interviewed Jeff Curry, the head of Goldman Sachs commodities research, he says, look, the biggest problems we have in the commodities world are we got to put a price on carbon, and we also need to figure out how to solve this warehouse receipts problem in commodity futures because it's just wrought with risks and so forth. They really ought to be tokenized on a blockchain somehow. A week later, I'm interviewing Tom McMahon, and they're actually building an exchange in Singapore that addresses both of those things, a new natural gas contract to help put a price on carbon, and they're also tokenizing warehouse receipts, which are something that doesn't exist in the stock market. I don't know the stock market anywhere close to as well as I know futures, so I can only imagine here, but help me fill in the blanks. What could be better about the way stock markets work, and what, if anything, are you guys doing at Neo to maybe spin things differently than functionally the way it works on other exchanges?
Yeah, I think the key point here is really what are we doing? And what are we doing that is different, and where we try to address some of the issues that I mentioned earlier. And I think technology can play a very important role in that, indeed. And let me give you a very concrete example. Earlier, I talked about how certain exchanges are enabling the high frequency trading community and enabling them, in fact, in deploying strategies that are detrimental to long term investors and to capital raisers. At the same time, I said very clearly, I'm not anti-HFT because I think they can add a lot of value. But you have to manage them. You have to manage them just like exchanges in the past managed people who had an advantage and were working and creating an unlevel playing field where everyone was no longer treated in a fair way. Think about the first user of a carrier pigeon. Think about the first one to have a phone in the exchange building. What the exchanges used to do in those days is they said, okay, let's make sure that everyone has a carrier pigeon. Let's make sure that we put phones in there for everyone so that trading remains fair and that everyone feels good about trading and that we don't feel that there's always someone winning and someone losing. And that is what we also did with our trading platform. So we never said to HFTs, don't come to our exchange. On the contrary, I'd love them to come because they can add value. But we put a number of mechanisms in our model, in our trading engine, driven by technology, driven by analysis, where we counter certain strategies. We build in a speed bump to take away the speed advantage that they have. We build in different prioritization of the matching of orders. When your long-term investor is sitting at the same price as an HFT, we're going to give a long-term investor priority. We protect market makers, those who are committed to provide at all times a quote in a security, which is important. We protect them with our speed bump. So this promotes quality of execution for the long-term investors. It promotes liquidity for the security. And it's a number of mechanisms. And there are more than that. I just give you a couple of examples. But those are mechanisms that we developed, implemented in our technology, in the technology of our trading engine, to create a fair, level playing field where investors feel comfortable, where when they trade on our exchange, they know that, there's not someone else who is always winning. That is one example. Another example of what we do is with respect to the listings process. So as I said earlier today, many exchanges look at listings as a transaction. Let's try to get them in, get the money, and then they figure it out. Well, we spend a lot of time with issuers, trying to make them understand that becoming a public company is a very big commitment. It's not only a milestone or something that you should feel good about. It's a commitment. It's almost like setting up a new business line that needs to support that. That is going to make sure that you manage and interact with your investors. And we give them a full overview of what it takes to be successful when you go public. And we learn things ourselves. Like, I don't pretend we know everything. We started really to reinvigorate the spec space here in Canada. So that is Neo. Neo has, I think, now 6 or 7 specs listed. There's 2, I believe, on the TSX. And there were lots of failures in the past with specs in Canada, and we tried to learn out of that. And then we spent time with the founders, and we spent time with the companies to look at what is important to make a spec listing and then the resulting qualifying transaction successful. And then once a company is listed with us, we continue to interact with them and talk with them about issues and challenges that they face. Company was facing short selling. We don't say to the company, oh, you figure it out. We spend time with them, understanding them, helping them to manage it, helping them to look at what it takes to tackle it. Talk with the regulators and tell to the regulators, well, wait a minute, there's something going on over here that you maybe didn't spot. I think that is where you are different, and you leverage technology, you leverage services, you leverage capabilities, experience, whatever you want to call it, and as long as you are driven by the best interest, you have clearly defined who your customers are and who you care about, and you're driven by their best interest, you can use all kinds of tools in your toolkit, from technology to services, to new services, to partnership models, etc., etc. And that is what we have done. Market data, a good example also. We're an exchange that is charging market data at a reasonable cost. Does that sound bizarre? Why are we not? Again, I think you mentioned it earlier. Why are we not trying to charge as much as we can? Because you got a bit of a scenario with market data from exchanges where you have a captive customer. We said no, we don't do that. We want to be remunerated at a fair level for the service that we provide, but we want them to be successful. We want investors to be successful. We want them to use our data, and the more use it, and the more we spread it out, we make our revenue by providing a quality service and having lots of people participate to our exchange. That is what it's about. So it's a philosophy, I would say, more than anything else.
I want to come back to what you said a few minutes ago about protecting the suppliers of liquidity, because this is so important, but I want to make sure that everyone understands it. In the old days, when we had specialists in the stock market that were providing liquidity, those are the guys that are there as the buyer of last resort in extreme events and market crashes and so forth, when you need liquidity the most in the market. Those were the guys that kind of kept the market stable and provided the stability to prevent flash crashes. That was a really important part of the market. And I think that the high-frequency trading community has persuaded people you don't need those guys anymore, because the HFTs provide a huge amount of instantaneous liquidity in all the markets all the time. And the thing is, that's true until it isn't. When the markets start to have an event, those algos shut down on a millisecond notice, and there's nobody left, because the guys who were in that business of providing liquidity to stabilize markets got run out of business by the computer robots. It seems so important to me. Do you find that the institutional investors that trade with you understand this problem? Because I've noticed that certainly in the retail community, people who are hurt by this risk don't understand it. They don't understand what could go wrong as a result of those market makers being put out of business.
Yeah, I think at the institutional level, there is an understanding about that more than at the retail level. Would I say that everyone gets it? No, probably not. And again, there's an element of education, and that is important. And I think, to your point, what happened over here when the HFT community emerged, and I think it really started mid 2000s, so 2004, 2005, if my memory is correct. Everyone saw that liquidity coming in, and everyone said, "Wow, these guys are great. They had a lot of liquidity." And exchanges then very rapidly said, lots of liquidity, lots of volume, love those guys, let's support them, let's make it easy, but not thinking about the consequences, not thinking about the impact. And one of the impacts that was there and that a lot of people missed is that with their speed, they were continuously sniping at the established market makers. So the guys, as you said earlier, that were providing liquidity for years, that were there, that are the liquidity provider of last resort. And they put quotes there, and they were every time too late. HFT would take them out every time when there was a change in price, driven by whatever. Let's call it a gold company listed on NYSE, and the price of gold changes somewhere in Chicago. They knew it before the market makers. Take them out, and the market makers kept losing. They kept losing money. So what did the market makers do? They start to widen their spreads. They start to reduce the amounts that they quote. And finally, they don't make any money anymore, and they start to pull out of the market. And then the markets start to depend from a liquidity provision on the HFT community. And to your point, they are there, when it works for their algos, it works for their model. But as soon as it doesn't work, they pull out, and then you get flash crashes, and then you get prices. We've seen, if I remember well, my memory is correct, Accenture trading at $1 at a moment because there was no one there anymore to support, to step in, and to think a little bit. And we've been through, all we've seen extreme scenarios, and I think that exchanges don't pay attention to that anymore. They don't think about that. They don't think about the consequences. And that is where indeed we are different, and we put mechanisms in place. And now, to be again very clear, that does not mean that an HFT cannot be a market maker on NEO. We have HFTs that are market makers on NEO, and that works well. And they like to work with us also because, again, we also protect them from other parties, other HFTs that would come with a predatory strategy, which makes it easier for them to quote narrow spreads, makes it easier for them to provide larger quotes, makes it easier for them to make money out of doing that. And that component, by the way, is very important because you need to be able to make money out of fulfilling that role to also stay in that role when you really need it, when the market is going, crazy on you. Like as a market maker, you are going to stand in there longer because you know that it's part of your role, and it's that role that allowed you to make money. But if you don't make money under normal circumstances and someone else walks away with it all the time, well, you're definitely not going to stand there when the market goes against you. So I think we need to reestablish that virtuous circle of market makers are there to participate in the market, provide liquidity, make money when they provide that role. And then, when the markets really need them, they will be standing there, they will be supporting it. If they cannot make money, they will pull out, and there will be no one there at the moments that they are most needed. So, yeah, I think that's a big issue, and that's an issue that we have sought to address with our trading model.
Another big scandal in stock trading is this notion of naked short selling. And the scenario there, when you're selling a stock short, the way that transaction works is you have to borrow the stock from your broker first. So you borrow the shares so that you can sell them and later repay that loan in shares after you've bought them back. That's the way the transaction is supposed to work. Somehow, it seems that it was possible for many years, I don't know if it still is, for people to sell short without ever borrowing the shares to start with. And there was a famous story, I think it was Overstock.com, it might have been a different company, but normally in these shareholder meetings, they never get anything close to 100% vote because, not everybody votes in shareholder votes. They had a meeting of shareholders where something like 200% of the outstanding shares voted. More shares voted than shares exist. And the way that happened is a whole bunch of people who had bought stock from short sellers who didn't really have the stock to sell because they never borrowed it, created a larger number of owners of stock than stock existed. That is just, it's so fundamentally corrupts everything you could imagine about how the accounting of ownership in a public company is supposed to work. But this went on for years, and what I've never understood, Josh, maybe you can help me understand, is how in the heck were the exchanges allowing these guys to sell shares that they didn't have, that they didn't own, and they hadn't borrowed?
Well, I think, like every time, there's not one simple answer to a question of that nature. I think the entire approach around short selling and what you need to do or don't need to do when you go short is driven by rules and regulations that are defined by the securities regulators and or the SROs. So in the US, it would be the SEC and FINRA, I guess. And it's typically rules that are not defined at the level of the exchange. It is also something that is tackled in the rules of the depository. So in the US, that would be DTCC. And what do they do when someone can't deliver the stock when there's a transaction that took place because they did a short. So I think that is where the problem needs to be tackled. And I think that we have been making progress more in the US again than in Canada in addressing some of those things by starting to impose rules whereby when someone goes short, the dealer has to make sure that they have access to that stock, that the borrow is there, and that they can properly ensure, delivery on payment at the securities depository. And I think that helps. Now, there's still ways to go around it, and I think that needs to be, further addressed. For me, in fact, where we should get to, that is, if someone goes short, there has to be a lock on the stocks that will be borrowed to enable the settlement of that security, so that we don't get in a scenario where stocks are used, multiple times. The same stocks are used multiple times because people are going short across the board, and then they look at the same potential lender of that security. So we need to establish a relationship of a 1-to-1. The regulators are the ones that will be driving that because they need to impose those kinds of rules upon the dealers. Now, where do the exchanges fit in that equation? I think exchanges play a very important role because when you have those kinds of practices taking place, and there's many other examples of where there is inappropriate or predatory short selling taking place in markets, it impacts the credibility of the exchange. It harms the investors, it harms the capital raisers. And I think that as an exchange, you have to be a champion for those things. Even if it's not your rules, you should be standing up for those investors and those capital raisers and go and talk with the regulators and tell them, guys, this is what's happening. This is not good for the investors. This is not good for the capital raisers. This is not good for the credibility of our capital markets. This is not good for investor confidence. Let's work on this and let's address this. And that is one of the things that we have done around the form of short selling that we've seen around, what is called both deals or capital raisers, companies that are already public, where you could kind of feel that when those transactions were taking place, certain parties were aware that it was going to take place before it was public and started to short. And then when the capital raise is taking place, well, they are one of the participants who had capital raise, so they went short, and then they get the stock at a lower price with a discount, and they make a profit without taking a risk. But who has been losing? The investors that were buying against them when they were shorting, the shareholders because the valuations go down, and the company. And we look at those things, we identify those things, we bring them up, and then we raise them with the regulators. And I think we have that responsibility as an exchange, but exchanges don't seem to care. They say, that's not my problem. You figure it out and you go and talk with the regulators. How do you have a corporate issuer that is experiencing an issue like that go and talk to a regulator? How do they figure it out if there's not someone who's going to help them, stand next to them as a partner? That is what we miss. Now, last comment that I want to make about short selling, and I want to be very clear, because nothing is black and white. You cannot say HFTs are bad. You cannot say short selling is bad. I think that short selling is a component of the markets. I think that it adds to the liquidity of the market. It's important for liquidity providers to be able to go short. It's important for people who have a vision and who translate information about the market to go short, as long as they are covered with a borrow. So short selling is not a bad thing. So let's please not go again to a scenario where the world always has to be black and white. Short selling is bad, HFTs is bad. No, we have to understand the issue and we have to address the problems. And we cannot just try to eliminate everything, because that is not the right solution either. But I think an exchange should have feel the responsibility and the accountability to take a leading role in addressing those things, either because it is in its own control or because it should be an advocate for its core customers. And exchanges don't do that anymore.
Jos, I want to come back to some of your earlier comments about being either transactionally focused or partnership focused in your relationship with the stock issuers. Because something that Canada has received praise for, or maybe I'm just reading the press release, I'm not sure, is Canadian markets are supposedly better equipped than most other countries to support smaller companies going public, because in addition to the regular big board, if you will, of Canada, which is the TSX, there's also another exchange called TSX Venture, which is specifically designed to allow smaller companies to go public. Everybody assumes that's a good thing. Is it a good thing, or is this a case of maybe in some exploitation of smaller companies that shouldn't be public, and maybe naive CEOs going public before it's really good for their shareholders?
Well, you're hitting one of my favorite topics, and one of the topics where I always create a lot of reactions here in the Canadian market when I come out with my views. So NEO is not listing venture companies. In Canada, you have a definition in legislation that you have venture companies and non-venture companies. Venture companies list on an exchange like a TSXV, non-venture companies list on a TSX or NEO. What I fundamentally believe is that it was a great idea, and it maybe worked at one moment in time when all the intentions were right, and maybe before exchanges became for-profit organizations. But what I see today is a couple of very straightforward facts. One, a lot of companies that are listed on those venture exchanges in Canada are absolutely not ready to go public. And the burden of being a public company is very heavy on them, and they are not able to spend the time anymore on their core business. And we see them failing. Two, I see retail investors, because it's listed on exchange, all kinds of retail investors, moms and pops, who are investing money in venture companies where you and I know, just because we know what the word venture means, that maybe 2 out of 10 will succeed and the other 8 will fail. That's venture business. We all know that. But we allow those investors to be exposed to that. And they, sadly enough, don't work like a venture fund, or they are not going to spread their assets across a multitude of companies to create a diversified portfolio where they manage their risk. No, they're going to go on those things that seem to be very promising and where there's a little bit of hype around. So I think that is bad. Now, why are companies doing that? I think there are 2 reasons that I can see. I think some companies are doing that because they can't find capital, and they need capital, and they can't get money from a bank. They can't get money from VCs, or they don't want to work with a VC because that comes with other consequences. And they can't find any other investors anymore. And this is an option that is suddenly offered to them. You could go there, and there will be, some people crazy enough to invest in your company on an exchange. And then they go for it. And it's a bit by despair or by lack of other opportunities. And I think, again, that is where we as an exchange have a role to play. I think we should not push them to do that because indeed it's going to be another transaction that's going to generate revenue for us. We should come with other solutions. And what we did at Neo, next to our exchange, we developed another platform. And that platform is there to allow asset managers, but also private companies that are not ready to go public, to raise money privately. So it's a multi-asset distribution platform that we developed, and even through some different models and within the frame of existing regulations, retail investors can even participate to it too, but in a risk managed way. And I think that is what is important. The last thought that I would like to leave with you, because you could say, okay, good, I hear your words about the risk that it represents for the investor and the burden for the company and et cetera, et cetera. What other, do you have facts? Well, I'll give you one fact, which is very simple. And that is, look at the indices in Canada, look at the composite index for the TSX, and look at the composite index for the TSXV or the Canadian Securities Exchange for that matter, and look at how they are diverging. Like the long-term trend of the TSX index, and we're a little bit too young to have an index, but the TSX index is going up, with its bumps, like every index in the world, but it's going up. The venture index is in a downfall since 2010. And I think that tells you a lot about what companies expose themselves to. That tells you a lot about what investors expose themselves to. So maybe it was a good idea in the past. Maybe it worked well when people were doing it properly with the right intentions. But clearly today, for me, it is not a model that works anymore. We need alternatives, and that is what we are focusing on.
Jos, I want you to pretend for a moment that you were dictator for a day. You're allowed to completely change anything that you want about securities laws or the structure of things if you wanted to make the world a better place so that the issuers of capital and the long-term investors were better served by equity markets than they are today. And you were allowed to change any of the rules about how anything works. What would you change and how would you make it better?
The first thing that I would do if I was in that position, in fact, is not changing rules or changing models or changing anything else. I would impose a training course on every investor and a training course on every capital raising company so that they fully understand what it is to invest money and what it is to go public with a company or what it is to raise capital in general. Because the biggest issue that I still see is a lack of education and a lack of understanding of what it takes. And other people take advantage of that. That would be my first thing. The second thing that I would do is make sure that exchanges are either in a position where competition is totally unfettered, like there's no service that you have where you are in a position of a captive customer. So everything you do, there's someone else who can compete with you on that without any limitations. And if you have a service or a role where you cannot do that, good example is market data, then that component needs to be managed, monitored, and controlled by the regulators. The regulators have to step in, like the SEC was trying to do it in the US, have to step in and say, here we have a captive customer, the competition model doesn't work. I remember how we both agree about the model of capitalism being a good model. That model only works when there's real competition. And there are areas like market data where competition cannot work because there's a captive customer concept. They need them to step in. I think that if we manage to do that, competition will make sure that everyone will slowly but steadily move back to giving the best possible service to those two entities that we talked about a lot at the beginning, investors and capital raisers, and regulators will make sure that no one is abusing any form of position of monopoly that they have. If we manage to do that, the world will look different. And if you look at what I'm doing with Neo, wherever we can compete, we are, a very hard and tough competitor to the TMX, and in a friendly way. Like, I have no bad feelings about that organization. They've been in a position of monopoly, and we know what happens when you're for profit and monopoly. So we're going to step in, we're going to compete, we're going to innovate, we're going to do things differently, and they're going to adjust, and that's going to be a great thing. And then there's a number of areas where we can not properly compete with them. That is where the regulators have to step in, and we're pushing the regulators to step in with respect to the market data. We're expecting regulators to step in the area of some forms of tight selling that they can do because they have other components in their service offering. So that is how we try to push things, and that would make the world much better.
Jos, you mentioned a company MindMed earlier, which is doing research on biotech, but it's psychedelic. That is to say, the types of drugs that were very popular in the 1960s, like LSD and so forth, psilocybin, these kinds of what used to be recreational drugs are now being considered in much smaller doses for clinical applications. I think you also were one of the first exchanges, or you can correct me if I'm wrong, but you were one of the early adopters or early enablers of the cannabis stock listings, the pot stocks. Are you guys promoting drugs in Canada, or is this more of being progressive and oriented toward allowing society to evolve? How do you see the role of a stock exchange in areas where the companies are doing things that are let's say, controversial in society?
Yeah, I think it's a great question. And, we are a progressive exchange. There should be no doubts in your mind about that. And what means being a progressive exchange, that is that you have to be open-minded. No, we're not a promoter of drugs, but what we do see is, there's lots of developments taking place in our society. And we can talk about psychedelics-inspired biotech. We can talk about cannabis in the medical space. But we can also talk about, things in the technology space. We see a lot around augmented reality. We see a lot in whatever. Think about the way communications is taking place and so on. And what we try to do as an exchange is to enable things that are meaningful and that can have a positive impact on our society and that can be meaningful from an investment perspective and that can grow again companies and grow our economy and so on. And I think we have, as an exchange, an important role to play over there, and not, be 5 years behind the evolution of the world. We have to be at the forefront of the evolution, and we have to be part of it, and we have to be part of it in a smart way. Because what you notice with those types of companies, that is, I think they hold an incredible promise. The entire psychedelics-inspired biotech holds an incredible promise to address one of the biggest pandemics that is affecting our world, because everyone talks about COVID-19, which is a horrible situation in which we all are today. But we start to forget a bit about something else, which is another pandemic that is probably worse than COVID-19, believe it or not, but that is all the mental health issues that we see, the addictions that we see. And the psychedelic space is holding a promise over here. And research is demonstrating that there are some answers over there to address these issues. Well, I think that as an exchange, we should not be sitting back and saying, well, this is not really something that we should get involved with. I think we should be embracing that. We should be open to that. We should be enabling it. But we have to do something else at the same time. Takes me back to my comment about some venture exchanges. That is, we have as an exchange to play a role in enabling companies that are serious. Because what is always said when you have a new emerging industry, a new emerging technology, that is, you have some people who see that and who say, oh, let's also set up our company. There's a hype over here, and we're going to let lots of people invest in it. And, well, yeah, maybe it's smoke and mirrors, but they will only figure that out after they've invested. So an exchange has to play an important role over there. One, it has to enable it, but it also has to make sure that we avoid all those kinds of pump and dump scenarios that are, sadly enough, still commonplace in our industry. And that, by the way, is not a Canadian phenomenon also. Only you see that in many places. You even see that in the US. But you will not see it on the main board exchanges. Or let me be careful about this, because nobody is perfect, as I always say. You will rarely see it on the main board exchanges, because they have standards and requirements from a governance perspective, from a size perspective, from a maturity perspective of an organization, that should prevent those kinds of things. So yes, progressive, but always with the best interest of the investor and the best interest of the capital raiser in the back of our mind.
Well, Jos, NEO is clearly gaining traction. I know that our friends at Apex Technologies, the sponsors of this podcast, chose to list first on the NEO exchange. How do you see your exchange growing in terms of, and for both investors as well as issuing companies? How can they find more about your plans and where you're headed?
Yeah, I think we made, great progress since we launched 5.5 years ago, and it's a step-by-step progress. You don't Rome was not built in 7 days, and NEO is not built in 7 days either. And I think it's step by step, building the right value proposition, educating, communicating, and proving that what you say and that the vision that you have works and is going to be beneficial for the investor and is going to be beneficial for the capital raiser. That is how you build. And what is important for us now, it's to continue to spread the word. Being able to have a discussion like we had today with you is very important to us. Having people that are listed with us share their experience with friends and partners and other people, having law firms talk about us. That is, we'll do our marketing also, but in fact, what works best in our case is the word to mouth, and then people looking at how we are performing and how we are executing upon what our promise is. That is where we see our growth coming. That is where we see our acceleration. And I think that for those who are listening to this podcast who've never heard about NEO, what my recommendation would be is go and have a look at our website. It gives you a very good feeling of who we are. And by the way, you're going to see a very different website. It's not the one that you would expect based on experiences you may have had with other ones. We got a lot of good and positive feedback about it. Our market data is available there, by the way, real time at no cost, which is also very interesting to be aware of. So neostockexchange.com, that is our website. Have a look at it and you'll find more information. But more than that, I would say, look at some of the companies that are listed with us and go and talk with the CEOs. Go and talk with some of the investors and ask them what they feel about us and how they think about us. Because ultimately, that is what makes the difference. And what is great for us is that whether it is investors, capital raisers, dealers, lawyers that work with us, they all share a common view that we're doing things in a different way and in a better way. And I can say that 25 times. So I would say to your listeners, don't ask me, but ask our investors and our capital raisers. And then come and have a chat with us. We'd love to see you join our family also.
Jos, thanks again for a terrific interview. We strive to make Smarter Markets a listener-driven program and always value your feedback. Some of you told us that you particularly enjoy guests who are good storytellers and who can share their war stories as veterans of the industry. So my guest next week will be MBF Trading founder Mark Fisher, a multi-decade veteran of the commodities markets and the only guy I know of who uses the Hudson River as a risk control in his trading system. Mark will tell that story and a few more in next week's Smarter Markets. Listeners, please help us get the word out about Smarter Markets. It's not every day you come across a podcast with guests on the caliber of Jeff Curry, Mariam Ayati, and Robert Friedland, and we have a veritable who's who of industry legends lined up for interviews in coming weeks. Your ratings and reviews on Apple Podcasts and other podcast platforms mean the world to us, as does your help spreading the word about Smarter Markets via word of mouth. For the Macro Voices Podcast Network, I'm Eric Townsend. See you again next week for another installment of Smarter Markets.
That concludes this week's episode of Smarter Markets. For free episode transcripts, visit SmarterMarketsPod.com. Smarter Markets is 100% listener-driven, so please help more people discover the podcast by leaving a review on Apple Podcast or your favorite podcast platform. Smarter Markets is presented for informational and entertainment purposes only. The information presented on Smarter Markets should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Smarter Markets are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Smarter Markets, its producers, sponsors, and hosts, Eric Townsend and Abex Technologies, shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Smarter Markets.